hello, business builders, and welcome to Business for Breakfast, where business is the most important meal of the day. I'm your host, Aaron Novinger, the Venti Business Guy. Our goal in this channel is to give you a ton of micro lessons, really to help you mind your own business. Hang out with me today as we drive and dive, where we dive into topics every business owner needs to know about, especially us mom and pop venti shops, right? Today, it's all about taxes. So buckle up and let's roll. All right. I can't even wait for today because I get to teach one of my favorite subjects, which is understanding the chaos of the tax system for us mom and pop business owners, right? Understanding the different types of business taxes. So what we're going to cover in today's lesson, and this is going to be broken up into probably, I think 4 or 5 parts, but I'm going to break down really every element of taxes. And my goal is that after we complete this series, not only is it going to be a reference that you can go to and use to get that knowledge, but to be honest with you, I think you're probably going to be in the top 10% of knowledge when it comes to accountants, because remember, not all accountants understand this, right? You get that, right? Most accountants will do personal taxes. Yes, some of them do business taxes, but what you're going to learn today is everything your accountant knows, okay? So at the end of today's course, you're going to understand the different types of business taxes and really how they apply to your business. You're going to learn the tax implications of the different business structures. You're going to get the skills in calculating the tax liabilities for different entities, right? We're going to identify key tax saving strategies for business owners. And we're going to develop proficiencies in preparing basic tax returns for sole proprietors and S-Corps, okay? All right, so a quick little overview, right? This lesson really introduces the different fiscal responsibilities that business owners have to know about, right? You guys know we talk about it all the time on this channel. The 7 plates of business, right? Plate 1 is the trade, plate 2 is accounting, 3 is sales and marketing, HR, customer service, logistics, IT. You get it, right? Okay. But here's the kicker. In my opinion, the most important out of all, the most important plate out of all of them is plate 1, which is the trade. That's the business that you run day to day. But in my opinion, out of the next 6 plates that you have to spin, the one that is the priceless china that you do not want to fall is the accounting plate. And that's why today I really want to delve into the accounting piece of this for you as a business owner, because understanding the taxes and how everybody gets a piece of your business is going to make you so dangerous and deadly, because from this moment forward, we aren't giving the tax man anything more than what we legally have to give them, okay? So we got to understand the bottom line, okay? Most mom and pop business owners, okay, start as sole proprietors, okay? Usually, oftentimes we start a business, we form an LLC, which by default makes us a sole proprietor, okay? And we actually are usually unaware of the tax consequences of that happening, okay? So let's start with local and county business taxes. Okay, we're not even getting to the federal part yet, okay? And most of our clients that we serve at our accounting firm are the mom and pop venti shops, and I would say most of them are service-based businesses, okay? So most of them have to pay the local and county taxes, okay? So most small business owners, you start a business, who's helping you to tell you, don't forget, you need to register with the county, with the state, so that way you start paying sales tax? Huh? Nobody told me that. Yeah, I know. But you have to know that your county and state, and sometimes your city, are all gonna want a piece of your business, okay? The license fees typically are like flat fees, anywhere between $50 and $150 based off of your state, okay? But here's the kicker. Let's talk about sales tax. Okay, so we understand local county business tax, right? You basically got to have your requirements, certifications to even be in business, okay? And those are just permits, right? But now let's talk about sales tax, right? Sales tax is one of those taxes that, if you're not careful, will absolutely sink you, okay? If you sell a product like physical goods, you must collect and remit sales tax to your state, okay? Period. End of story. Now, each state handles delinquent sales tax differently. Okay. Texas is one of the worst states to ever be late in for anything, especially sales tax. OMG. Okay. We just did this last year as a side-by-side. I took a restaurant and I basically did their sales tax in Oklahoma, and then I did their sales tax in Texas. And I wanted to compare the difference. And I basically, it was like the same amount of revenue, and I had them the same 10 days late for Oklahoma, and then for Texas was like a $250 late fee. Oklahoma was like $37. I'm not kidding, okay? There is no comparison between Texas late fees than most any other states. Okay, so keep that in the back of your mind. You sell a physical product, you best be collecting sales tax, which means when you collect the revenue, that sales tax is not even part of revenue. You're basically, the state is saying that each small business is a micro bank, and your job is to hold the state's money and then give it to them when they tell you to give it to them. And if you're late on giving them their money, they're going to hit you with late fees. And based on the state, it doesn't take very long before they come in with a constable and literally put a lock on your door. I am much more afraid of a state revenue collector than I am the IRS. I know that sounds crazy. The IRS has certain rules and regulations and stuff like that that they follow. States, whoo, just think of them like the mafia. They can do whatever they want. Literally do whatever they want. Okay, they're the cartel, right? And so now, I think we have a major understanding, but the key takeaway, right? Check with your state tax agency so you don't have to pay penalties. Got it. Now, federal and state unemployment tax. Oh yeah, if you hire employees, you're responsible for unemployment taxes. What? Yes. I just wanted to, people told me I have delicious food and I wanted to cook food for people and have a restaurant. I know. That's so cute that you want to do that, but you have to understand, you got to be a revenue collecting machine for all these entities. They make you do the hard work. I know, it's crazy, right? But mom and pop businesses often hire family members or part-time help, and the thing is, that still requires payroll tax compliance. Now, in one of the other lessons, we're going to talk about how to hire family members and do it without paying that, okay? But understand, just by the book, anybody that we pay, okay, we've got unemployment taxes, right? Self-employment taxes. Unlike employees, self-employed individuals must pay both the employer and employee portion of the Social Security and Medicare. Now, you know it's like 13.5%, right? And when you have a W-2 job, the employer pays half and you pay half. But when you are self-employed, you started an LLC, and by default, you're a sole prop, which basically means by default, you're a W-2 employee of your own business, which means you have to pay all 15% yourself. You got to do it. 7.5 by, I think it's 15 or 15.5, something like that, right? Now, it's a major tax burden for most business owners, but you have to understand this is critical. I was hearing a stat the other day. Typically, businesses that get behind on their payroll taxes have an 80% closure ratio. I know, right? It's because once you get behind this snowball, it's just so tough to catch up, right? All right. Now, let's move into, let's see, expense deductions. and taxable profit. Okay, so most small businesses make the mistake of not tracking their expenses. This is so key, man. This is so key. Let's see, I'm going to tell you a story. In 2007, my wife and I were in Carmel, California. It was our 9-year wedding anniversary, okay? So this is 2007. And we were walking the streets of Carmel. Now, if you've ever been to that part of California, that was the first time we'd ever been. I remember like it was yesterday, the feeling that I had of this place is out of a fairy book. Because if you ever have seen like a Thomas Kinkade picture, Thomas Kinkade got his inspiration from downtown Carmel, California. When you go to Carmel, there's no mailboxes. It looks like a little gingerbread village. It's just awesome. I was walking down the street, looking at everything, saying, oh my gosh. And then my Motorola StarTAC phone. You know what I'm talking about. Oh, back at that time, I was a baller, okay? And it rang. And so I pulled it up, and it's clamshell. So I did this. I pulled the antenna, beep, and I did this, bloop. I was like, hello? Yes, this is Mary with the Internal Revenue Service identification number, blah, 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 blah. I'm just making a courtesy call to you, letting you know that you have been flagged for an IRS audit for the year 2005. Typically with audits, 3 years is typically what they go back to. And this was 2 years before. And they tell you, when you get flagged for an audit, they tell you what flagged you for the audit. So they told me. She told me, she said, it was your home office deduction and your mileage logs, right? Now, you have to understand, in 2008, there was home-based businesses, but they were like network marketing type stuff. Now, today, everybody works from home, right? But this was not the case in 07, okay? This was rare. But what flagged me was I started a cleaning company for my mother-in-law in 2002 that she still has today. And for the first few years, as a favor to her, I did her personal taxes, like the business taxes, on my personal return, 1040 Schedule C, okay? That's what flagged it. The practice, right, we have its own CPA firm, does its own taxes, has like its own 1120S, blah, blah, blah. But this was the cleaning company's taxes on my personal return, and that's what flagged it, okay? And basically, when I sat down with the auditor, she goes, okay, well, I gotta see the first thing that they do when they do an audit is they get that year's bank statements for the business. And she sits down and she goes line by line of every transaction in the bank statement. What's that? Can you prove it? What's that? Can you show me the receipt? What's that? Oh, we can't allow that. Every line item of every single month's bank statement for 12 months. It is the worst experience you've ever been through. Rebecca and I, what makes us so unique as accounting firm owners is we're one of the few owners that's not an accountant. We're small business owners, right? So your heartbeat is our heartbeat. What causes you stress causes us stress. And we're one of the few owners that's actually not been audited once. We've been audited twice, because you're about to find out why. One of the things the auditor did is said, hey, she said, I need to see your mileage logs. Now, at the time, we had 3 crews, 3 vehicles, 3 cleaning crews, 3 vehicles. Now, thank the Lord, my mother-in-law is like a semi-hoarder, okay? And this cat keeps ridiculous receipts. Thank God, okay? She and I sat down and she started pulling all of her stuff, but the auditor, I handed her the mileage logs and she said, oh, these are fantastic. But when you said that you went to Walmart to get supplies, just show me the Walmart receipt. When you said you went to the bank to make a deposit, no big deal, just show me the bank deposit slip. When you said that you went to go do an estimate, no big deal, just show me the estimate. When you went to do the job, just show me the invoice. I'm not kidding, okay? They make you prove every line item in your mileage log. I could not prove 5,000 miles. Only 5,000 miles. 3 crews the whole year. Couldn't prove that. And I don't know how many tens of thousands of miles we have between all the cars. And she said, oh, gosh, I really hate that. But unfortunately, the way audits work is that if there's any discrepancies in this year's audit, it's an automatic flag for the next year. So then I got audited for 06 as well. You have no idea what that is like. It is the worst experience you've ever gone through. Because no matter what, remember, these people, everything for their life is perfect, okay? They have no concept, not even 1% of what we have to deal with on a daily basis. They would literally break in half if they had to deal with 10% of the stress that we have to deal with, okay? But I am trying to help you realize what we're talking about today is to really help you be audit proof, okay? The way we run the practice and the way we work with our entrepreneurs is making sure we do everything by the book, but it's done from the point of view that it's not if, but when we get audited, okay? Not saying that we will, but you have to have that mindset when you're running your business. If you try to do anything that's, man, I just don't want the IRS knowing about that, you just spoke into existence, I promise you. You just spoke it into existence, okay? So understanding most small business owners don't track their expenses, right? Or they go the opposite because they went to some seminar where there was some moron at the front teaching some network marketers on what to write off for home-based businesses. Those people are idiots. And you've watched enough of my contents, I do not call names. But those people have done more damage than good. Because they'll be like on the front, hey, you stop over at Taco Bell, keep that Taco Bell receipt, just write the date and what you're doing on the top of it. Are you dumb? Do you actually think that works? No, it doesn't. The idiot that was teaching the class has never been through an IRS audit. Because when you go through the audit, you realize the IRS literally laughs at that. You show them that and they laugh, okay? It's important, right? We've got to make sure that we properly record our expenses, right? Which is gonna reduce our taxable profit, which is going to save you thousands in taxes. But there's just a way we gotta do it. Here's an example. Business with 140,000 revenue, 40,000 expenses, now we're taxing 100,000 in profit, right? It's simple, but we gotta do it the right way, okay? Now, to talk about taxes and how we're taxed, we need to compare business tax structures, okay? All right, scenario one, okay? This is an employee at a corporation, right? You're an employee, your employer is gonna handle your payroll taxes, right? You get that. So you get your payroll, the breakdown of taxes paid as an employee, and don't forget, a W-2 employee is the highest taxed entity in the United States of America. Did you hear what I just said? The highest tax entity in the United States of America is a W-2 employee. Now you understand why Uncle Sam has more money than they know what to do with to go do stupid things like send $50 billion a year to USAID, or to just decide they're gonna pick a fight with Ukraine because we're gonna fight over gas stations, okay? We have the greatest revenue collection system on planet Earth. It's not just the W-2 employees. Don't forget, when you form your LLC with the state, by default, the IRS makes you a sole prop. Because you have to understand, and we'll talk about it later, but an LLC is not a taxable entity to the IRS. They don't even recognize it. They recognize sole prop, they recognize individuals, right? They recognize partnerships, S-Corps, C-Corps, nonprofits, things like that, but they don't recognize an LLC. So by default, an LLC is taxed as a sole proprietor. A sole proprietor, okay, ready for this, is a W-2 employee of your own business. Did you hear that? A sole proprietor, your LLC, You are a W-2 employee of your own business according to the IRS, which means sole props, highest tax entity in the United States, and partnerships. So if you form an LLC and you've got a couple partners, by default, Uncle Sam makes you a partnership. Partnerships are just a bunch of sole props glued together. W-2 employees. So wrap your mind around what I just told you. Every W-2 employee, every sole proprietor, and every partnership are all taxed as W-2 employees. Crazy, right? I'm telling you, man. It's a genius system, bro. It's a genius system, okay? But if we're talking about breaking down the taxes for the employee, Social Security tax, 6.2%, right? Medicare tax, 1.45%, federal income tax, whatever that breaks down to, wherever it's at, your state income tax, right? You're talking about literally paying, it's thousands a year between all of the taxes, but you don't really know it because it comes out of your paycheck. So what gets deposited is the net amount. And that's what you just learn to get comfortable with, and in your mind, that's what you really make. But you actually make way more than that. But so much of it goes out the door for all the different state, local, federal revenue collecting agencies, right? Now, scenario 2, sole proprietor, okay? Remember, mom and pop businesses fall into this category if they have not filed as an S-Corp, which is Form 2553, okay? Now, biggest tax downside, you pay both sides of the Social Security and Medicare tax. Both sides. Because guess what? When you work for a company, the company pays half, you pay half. But your own business, you're the company. You pay it all. It's just the way it works, man. Okay? So it works the same exact way. Sole proprietors pay the most in taxes because self-employment taxes is doubled. So self-employed people pay more taxes than a basic W-2 employee at a company, because at least the company pays half of your social service taxes. Not when you're self-employed. You pay all of it. All of it, okay? Now, scenario 3, let's do the S-Corp, okay? Once you figure that out, and if you've got a decent accounting firm that gives you a little bit of education that basically says, we will not allow you to be a sole prop, you will be an S-Corp. It does 2 things. 1, reduces your chance of an audit by 95%. We'll talk about that later. And 2, reduces those self-employment taxes drastically, okay? The S-Corp strategy, you pay yourself, let's say you pay yourself $40,000 salary, right? That will be subject to the payroll taxes. Let's say it's $100,000 you're taking a year, right? But instead of taking all $100,000 of it as income, like we do for a W-2 or self-employment business, right? We actually go in and we actually divide up how we pay ourselves. We'll put ourselves on a $40,000 a year salary, right? Then we take the remaining $60,000 as a profit distribution, avoiding self-employment taxes. You heard that right. Orange mocha frappuccino. All right. Total taxes paid, $24K, playa. The lowest of all the tax burdens. The bottom line, if the business is making over $50K a year in profit, you got to be an S-Corp. You got to be an S-Corp, okay? Now, let's shift into understanding the tax rates, okay? So we have to understand that there's a difference between a marginal tax rate and then like an effective tax rate, okay? So when you hear of like the United States is a marginalized tax code, okay? Meaning, yes, there's different tax brackets, right? But it's marginalized, meaning the rate applied to your last taxable dollar, right? So this is really important for business owners when estimating how much extra income is going to be taxed. So because our tax system, and it changes typically every year and with every administration change, meaning left or right, the tax brackets and those percentages change. Okay, so let's say now it's 10%, 12%, 22%, 24%, 35, 37, something like that, okay? But each of these amounts is a range. So the first 10% of your tax is like the first like $10,500 that you make. okay, is going to be like taxed in that capacity, right? It's going to be taxed just like that, okay? They're going to break it down for you so that way you have an idea. But you make $100,000, right? First, we got to remove all of our standard deductions and blah, blah, blah. And then for each amount that goes into that bracket, you're taxed at that amount for that dollar figure. Out of that 100,000, let's say like maybe 60,000 of it is actually what you pay taxes on, right? What's going to happen though is not the full amount. So let's say 60, 70,000 of it is actually what you're paying taxes on because of our deductions. So we have 70,000, right? But then it's going to be broken into, okay, this much of the revenue falls in this tax bracket and you pay that. So that's why people are like, I'm in the 22% tax bracket, meaning the rate's applied to the last taxable dollar, but it's marginalized. You paid 10% here on this amount, 12% on this amount, 22% on this amount. You see what I'm saying? You work your way up, right? That's a marginalized tax rate. Effective tax rate, that's the actual tax burden, right? And it's the average of those different brackets and how much you paid into them and at what percentage, okay? So for instance, a taxpayer that's in a 22% tax bracket, because remember, the marginalized, which is the rate applied to the last taxable dollar, okay? But if we're talking about the effective tax rate, we're gonna blend it all together and get the average, okay? The software that we use, our tax software and our retirement planning software, does all this calculating for us. But I can literally tell you for the state and federal what your effective tax rate, your marginal tax rate is. I know all of it, okay? Not just me, but everybody that works at the practice. But a taxpayer in the 22% tax bracket might have an effective tax rate of 13% after deductions, right? Like after we average it, minus deductions, it could be like 13%, which means out of $100,000, if maybe 70,000 of it's taxable because of our deductions, so that would be like 70,000 times 13%, not 22%. Get it? Make sense? Okay. Now, we were just talking about it, but let's talk a little bit more about it. The value of our tax deductions. Okay. Now, this is going to be key. This might be the most important thing from this entire micro lesson. Do not buy things just for the tax deduction. Okay? You got to make sure, you have to understand, whatever you do in your mind, if you have in the back of your mind, can I defend this in an audit? Can I defend this in an audit? Can I defend this in an audit? That's the question that you should be haunting yourself with when you buy something and you try to slide it to your accountant to have them expense it. Can I defend this in an audit? Okay, so just think about it. But if you've got the deductions, think about this. If you have $1,000, just think about this, $1,000 in deductions, and it's at the 22% tax rate, that's $220 savings. You get that, right? But the thing is, what you don't want to do is spend the $1,000 just to get the $220 tax break. That means you're still out just under $800, right? You get what I'm saying? So don't spend it, right? Just so you can say, I got the deduction. Now, there's a couple things you can do, which we do that for, like buying big cars or airplanes, right? Because how we can bonus depreciate and blah, 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 blah. Okay, that's later. But you guys understand this, right? So convert existing personal expenses into business deductions legally is going to be our best strategy to capture those deductions. And what I tell our clients is, when I'm working with an entrepreneur and I'm building their custom cash flow plan, and we're doing all this, right? I'll build the whole thing, how much they need to put in all the different accounts and all that stuff. But one of the things we typically will do, they'll have their own business, okay? And then we'll set up their own LLC, and we always have it filed as an S-Corp, Form 2553, okay? Then they will be a consultant for their business, and they invoice their business for their services, which means you're running your consulting business from the house. So many of those expenses, so what I say is, so imagine like creating that separate legal entity that's by the book, by the way, which allows us to grab and to convert a lot of the personal expenses into business deductions. Not all of them, not most of them, but a lot of them. And what I always say is, so just imagine dumping, I call it like a coffee filter. Okay, so you've got some like really thick coffee. It's got a bunch of grinds in it, and so you've got this filter, and so you pour it in, and the filter will capture a lot, but there's still going to be a ton of coffee that's in this cup. But the filter does catch a lot. That's us having our own little consulting LLC invoicing our business. I'm telling you, man, this stuff just, I don't know. Do you not get excited about this? I like nerd out on this stuff. Okay, I love it. Okay, now let's talk about paying taxes as a business owner. Woo! Okay, it's important. If we're profitable, IRS is expecting you to pay estimated taxes quarterly. Okay? Now, here's the kicker. What people don't realize is people are like, oh, my taxes are due April 15th. Okay, yeah, sure. That's when the paper is due. But if you owe money on that tax return, Uncle Sam, their mindset is that money was actually due to us December of last year, 5 months ago, 4.5 months ago, April 15th, 4.5 months ago. That's when this money was due. Even if you pay your taxes on April 15th, if you owe money, it already has late fees in there. It does. It does. Okay. The only way to avoid that, pay that stuff in the year that it's due. Okay. The IRS penalties, unlike state penalties, they're typically not huge. State penalties tend to be usually a lot worse. But I'm telling you, most mom and pop venti shops do not set aside the money they need to for taxes, which is why whenever we onboard a new client, we always put them through orientation, and I build a custom cash flow plan where we allocate into all of the appropriate subjects, and the most important one is taxes. Okay, so once you become a client and you go through the orientation and we build your custom cash flow plan, you'll never struggle with taxes ever again, ever, unless you don't follow the plan. Got it. Okay, now let's shift into topics and talk about tax return filings for business owners. Okay, now we understand that there's like the two main ones would be like sole prop and then S-Corp. Okay, so a sole proprietor, again, it's either it's an LLC or home-based business, right? But it's on your 1040 Schedule C. Okay, 1040 Schedule Cs are due April 15th. Okay, and remember, every single dollar that's showing profit from that business will be considered to Uncle Sam as a paycheck. So they're going to make you take out all those taxes, self-employment, everything. Okay, you're basically, that business profit is taxed as personal income, period. Okay, now S-Corps. So remember, form an LLC. For you to be an S-Corp, you got to do Form 2553. You can do it yourself. It's very easy to do. But they actually file something called an 1120-S. Okay? Now, S-Corps file a separate return. It's actually what they call 1120-S. S-Corp owners don't pay taxes at the business level. The profits from the business flow through to the personal taxes. I know this sounds weird. Okay, an S-Corp, unlike a sole proprietor, has its own tax return, but that tax return is only for documentation. Profit or loss is not, it's basically the ledger for Uncle Sam on this business. But this ledger does not owe any taxes. It's just basically the document for the IRS on how we calculated this profit or loss. Okay. Now, here's the kicker. What happens is you get a K1, right? So we do and each partner gets a K1. The K1 is done with your personal 1040. So the K1 is reporting what that 1120-S was showing. The K1 still goes on the 1040. But all of the income and expenses for that business are not on the 1040. That's on the 1120-S. It's a different tax return. Okay? Now, because it's a different tax return, and because that K1 has to be on your April 15th taxes, so it makes sense that the S-Corp returns are due a month early, March 15th. Okay? It's coming right up. Got a few weeks to knock these bad boys out. Okay? Hopefully, I've spent some time here explaining to you guys the different tax entities, how they work with the IRS. The most important thing is understanding the tax structures and really how to utilize them to save you the most money, again, legally, by the book, okay? So remember, big key takeaway, sole proprietors pay the most in taxes. S-Corps really offer, can be, yes, significant, but can be huge tax advantages, okay? The next lesson that we talk about, part 2, we'll be talking about our progressive tax system, and we'll be talking about tax planning strategies. So with that, I'm gonna jump off here, guys, and you know what time it is, right? It's time to get to work. We'll see you guys soon.